let's talk about IT as a group. Do you think the springtime for IT is over? Most of the IT stocks have appreciated, and most of the IT stocks have appreciated because currency was weak. Now that rupee is stabilized, do you think in the short term IT stocks could hit some kind of an wall?
See, there are three things with IT. One is, people were paying it for the currency, which now, seems to be going against IT in the sense that from its lows, at least the rupee is now appreciating. Second is people were playing it for the US recovery, that, okay, if the Indian economy is not going to do well, and relatively it's the US economy which is going to do well, then what do I really play? And that's where IT was coming through. Third is, in terms of performance, what we've seen is like a very sharp outperformance. Now it has become a consensus. A lot of people are overweight in IT. Most people hold a decent amount of IT in their portfolio. So to that extent, what we could see is, IT not doing well simply because everybody already owns it. And, people start wondering whether, now if the rupee is going to remain stable, then they should trim down that and start looking at other things. I think the trigger for IT underperforming is not really going to come from IT per se. It's going to come from some of the other domestic sectors starting to do well, or at least attract attention because people think valuations have become cheap, or the economy showing some sign of pickup.
Jyoti, it's the first of the month. Again, we would be having the monthly auto sales figures. Do you think there can be any sign of a recovery when it comes to the demand, or do you think the auto space is going to continue to be in a slump?
See, I don't think the demand is going to be very strong in auto for the next few months also. So, what we are really playing is that though the auto demand is not good now, are we nearing signs of a bottom, and do we see at some stage that this will start to pick up? Valuations are factoring in like sales which are probably at cyclical lows, and we start seeing a recovery beyond a point. So I don't think sales numbers per se will really excite the market. They'll be very good, but it's more like there's a hope that is this the bottom of the cycle, and is the future going to look better?
Jyoti, what is your take on flows? Because ultimately it's all about liquidity, and liquidity moves financial markets in the short term. Are you a bit surprised that foreigners are not dumping Indian stocks? In fact, in the month of September, there were net buys in Indian equities.
Yes, so I think we should be thankful that foreigners are more bullish on India than probably the Indians are. They have given India a long rope. In spite of all the problems we've had on India, people still have continued to look at the long-term story, that things are good, and there's been a lot of hope amongst the foreigners that things are bottoming out, will get better. So I think, a lot of the flows we saw in the last month came, after the change in RBI governor, the positive steps he announced on the first day. There was a lot of hope after that, okay, now we'll have probably a more supportive RBI which will take decisions faster. After the credit policy, people started realizing that, okay, it's not like going to be a quick fix to the economy. Things are still going to be slow, and even a change in RBI governor does not mean that their whole focus on inflation has gone away.
So, Jyoti, what is a prudent course of strategy in this kind of a market? Should capital preservation continue to remain is the name of the game, or now it's time to add some beta and it's now time to revisit cyclicals?
So, our view has been that this is the year where, we'll have the economy which will do worse than what people think, but markets will hang around at the range because everyone's hoping that, things will change after this year. Next year will be better. There are elections next year on which a lot of hopes are pinned that, we'll probably get a more stable government, and then we'll have policy correction which will help kickstart the economy. So our call for the year has been that the index will be between 18,500 to 20,500. That's the range for the index we've been predicting for the whole year. And, quite surprisingly, if you see so far, for most of the trading sessions, market has been somewhere in that range. There probably, 10% of the times market has gone beyond this range, but it's been really rock solid into this range. As the market rallied, like our call was post the tapering was postponed, that we are at the top end of the range and we should take some profits. We expect it to come back more or less to the bottom end of the range or somewhere there. and we continue to hold that wait for markets to correct before you start buying. So in the correction, you again go back to IT, go back to pharma, go back to some of these defensive names.
What is your take on absolute valuations? Based on FY14 estimates, the Sensex is still trading at a P multiple of about 14 times, and by any yardstick, in the current economic environment where economy is contracting and earnings are not growing, one would argue that is expensive.
Yeah, in fact, like our view on the Sensex EPS is even lower, so probably on our numbers it's trading at 14.5 times. See, markets are not cheap. Markets are trading at, close to long-term averages. The issue is there are some people who are taking the call that this is close to a bottom on the earnings and the economic cycle. So that's the only reason to justify this, because, over the last 5 years we've had earnings growth, which is average 7%. The last time we had something like this was in 1997 to 2002. In that phase, earnings grew like under 7%. But after that, we had a strong spell of sharp earnings growth, which, next 5 years average was 25%. So, there's a lot of hope that we are now close to a bottom on the earnings cycle, close to a bottom on the economic cycle. Once we get a new government next year, things will start picking up and the pickup will be quite rapid. So that's the reason, markets continue to hold at these levels, because if we go back into history, typically when we've had, very poor earnings numbers, very poor economic growth, markets have tended to go to something like 10, 11 PE, which, is not happening this time, because there's been that hope that, we are more or less close to the bottom.
So what is the correct PE band or the correct fundamental range for this market?
See, I would say valuation-wise, valuations are not cheap. So they're not cheap. One can argue that they're not extremely expensive also. So if we get a recovery in the economy, we get, the earnings starting to pick up, most of the return in the market will be led by earnings growth. So, there's not going to be any sharp valuation re-rating at these levels in the market. So it's going to be more like earnings growth. The good thing is valuations are still holding, because one could argue that valuations could come down. They could be 10% lower than where they are today. I think what is preventing that from really happening is two things. One is, like I said, there's hope that we are close to a bottom on the earnings and the GDP side. A lot of people are hoping that we get an interest rate cut at some point, which, starts turning around the economy. The second is we are close to elections. If we go into history of elections, typically markets do well in the run-up to elections. And if you take a 7-year history, there's only been once in the last 7 elections that markets have not done well in the run-up to elections. And most of the time it is hope that the last 1 year the government is not able to take reforms. As soon as we get a new government, they'll have nothing to worry about elections, so they'll take measures which are required to kickstart the economy.
Jyoti, do you think the current state of political affair in US is more like a blessing in disguise for a market like India, and especially emerging markets? Because if US shuts down, it will have an impact on US economic recovery. If US economy fails to recover, it will force Fed to really revisit all their tapering thought.
Yeah, that's one way to look at it, and a lot of people like to have that view. My view is different, that ultimately, you want economies to recover. Markets always do well when, growth comes through, when earnings start to come through. And, once you have earnings coming through, then you're more comfortable with, market rallying, rather than when earnings are not coming and you're just hoping liquidity is coming through. So I'd rather, given the two choices, I'd rather have a choice where the US recovers, where India recovers, we get earnings growth, and then, we can justify any sort of rally in the market, because you have earnings growth going back to 15-20%. So that's the scenario I would prefer. In the short term, of course, a Fed tapering or a Fed deferring of tapering is always good for markets. You get that relief rally which comes through. But if you go back to, the recent history, we had that sharp rally once, tapering was deferred by the Fed. But again, after that, we said, oh, okay, but, markets are expensive again, they will have to come down. So, that always ends up creating a market which is in a trading range, which goes up, and every time it goes up, you start feeling uncomfortable and you say there's no earning support to this market.